In this video, I will discuss on types of equity mutual funds for investment. Passive and active mutual funds, diversified equity funds based on market capitalization, based on sectors and industries, based on themes, based on investment styles, equity-linked savings schemes. 1. Passive and active mutual funds. Passive funds will invest your money in the company which is part of an index like Nifty or Sensex in the same participant as the company's representation in the index. In other hand, active funds select stocks for the portfolio based on the strategy that is categorized based on the way the securities for the portfolio are selected. 2. Diversified equity funds. This fund invests across segments, sectors, and sizes of companies. 3. Based on market capitalization. Large cap fund invests in stocks of large, liquid blue-chip companies with stable performance and returns. Mid-cap funds invest in mid-cap companies which has the potential for faster growth and higher return. Small-cap funds invest in companies with small market capitalization with the intent of the benefit of higher gain in the price of stocks. But the risk is also higher in these types of funds. 4. Based on sectors and industries. These funds will invest in companies that belong to a particular sector such as financial, technology, healthcare, FMCG, energy, services, chemicals, automobile, communication, construction, durable, metals, etc. These funds are riskier because of lesser diversification. These funds are concentrated in a particular sector. The trend of a return to be cyclical, and the return from investing in a sector is never the same across time. 5. Based on themes. Theme-based funds invest in multiple sectors and stocks that form part of a theme, like consumption, construction, banking, etc. 6. Based on investment styles contra, growth, value funds, and dividend yield. 7. Equity-linked savings schemes (ELSS). ELSS is a special type of equity fund investment that gives the investor tax deduction benefit under Section 80C of the Income Tax Act. Types of hybrid mutual fund or balanced mutual fund. Debt-oriented hybrid/conservative funds. Debt 75% to 90%, equity 10% to 25%. Debt-oriented hybrids invest a minimum of 75% to 95% in a debt portfolio. The debt component is conservatively managed with a focus on generating regular income, which is generally paid out in the form of regular dividends. The credit risk and interest rate risk are taken care of by investing in liquid, high credit rating, and short-term debt securities. The allocation to equity is kept low and primarily in large cap stocks. To enable a small increase in return, these funds are taxed like debt funds. Aggressive hybrid funds. Debt 20% to 35%, equity 65% to 80%. Predominantly equity-oriented hybrids invest in the equity market but invest up to 35% in debt so that some income is also generated and there is stability to the returns from the fund. Balanced funds are designed as equity-oriented funds. Balanced funds are suitable to those investors who seek the growth opportunity in equity investment, but do not have a very high risk appetite. Balanced funds typically have an asset allocation of 65 to 80% in equity, and 20 to 35% in debt. They are taxed and treated as equity funds, and to this always maintain at least a 65% exposure to equity markets. Dynamic asset allocation funds. Invest in both equity and debt but without a pre-specified allocation as in the case of other hybrid funds. The fund manager takes a view on which type of investment is expected to do well and will tilt the allocation towards either asset class. Such funds can even hold 100% in equity or debt. Multi-asset allocation funds. These types of funds invest in different asset classes like equity, debt, and commodity, like gold. At least 10% allocation in each asset class. Arbitrage funds. An arbitrage fund is a type of mutual fund that leverages the price differential in the cash and derivatives market to generate returns. The returns are dependent on the volatility of the asset. Capital protection funds are closed-end hybrids funds. In these types of funds, exposure to equity is typically taken through the equity derivatives market. The portfolio is structured such that a portion of the principal amount is invested in debt instruments so that it grows to the principal amount over the term of the fund. This provides protection to the capital invested. The remaining portion of the original amount is invested in equity derivatives to earn higher returns. Mutual funds are subject to underlying risk. Please read all documents carefully before investing. What are different types of debt mutual funds? 1. Overnight funds. These funds invest in securities with a maturity of 1 day. 2. Liquid funds. These funds invest into debt securities which will mature in less than 91 days. The primary source of return is interest income. Liquid fund is a very short-term fund and seeks to provide safety of principal and superior liquidity. 3. Ultra-short duration funds. They invest in the money market and other short-term securities of maturity up to 365 days. You can invest in these types of portfolios for between 3 and 6 months. The objective of these funds is to generate a steady return, mostly coming from the accrual of interest income. 4. Low-duration funds. The fund manager of this fund invests in debt paper which invests for 6 to 12 months. 5. Money market funds. These funds invest into securities with maturity up to 1 year. This fund invests in mostly money market securities. 6. Long-duration fund. As the name suggests, these types of funds anyone should hold for a long term, generally more than 7 years. 7. Corporate bond funds. These types of funds invest in corporate debt securities. These types of funds may generate higher interest income. Credit risk associated with this type of fund. 8. Credit risk funds. These types of funds invest in different credit risk papers. Lower credit risk paper may give higher return, and in opposite, higher credit risk paper may give you better return. 9. Gilt fund. These funds invest in government securities. It is a safer kind of fund as they invest in government securities. 10. Dynamic bond fund. This fund invests in the short-term and long-term papers by managing credit risk and interest rate risk. 11. Floating rate fund. These funds invest primarily into floating rate debt instruments. In these instruments, the coupon is not fixed for the term of the instrument but is periodically revised with reference to the market rate. 12. Fixed maturity plan, FMP, are close-ended funds that invests in debt securities with maturities that match the term of the scheme. It redeems in maturity and paid to investors. It issued for various maturity periods ranging from 3 months to 5 years. Mutual funds are subject to underlying risk. Please read the offer document carefully before investing. What is fund of funds? A fund of funds, FOF, is a mutual fund that invests in other mutual funds. It does not hold securities in its portfolio, but other funds that have been chosen to match its investment objective. These funds can be either debt or equity, depending on the objective of the fund of funds. A fund of funds either invests in other mutual funds belonging to the same fund house or belonging to other fund houses. Fund of funds belonging to various mutual fund houses is called multi-manager fund of funds because the AMCs that manage the funds are different. A fund of funds looks for funds that fit into its investment objective. It specializes in analyzing funds, their performance, and strategy, and adds or removes funds based on such analysis. A fund of funds imposes an additional cost on the investor, as the expenses of the underlying funds. Mutual funds are subject to underlying risk. Please read all documents carefully before investing.